For about a decade now, the Indian market has been surprisingly calm. But according to a really fascinating report from DSP Netra, we're starting to see the first little cracks in the ice, the first signs that this long, stable period might be about to unravel. So let's dive in and break down exactly what they're seeing. 10 years. Think about that. In the world of finance, where things change in a blink, a whole decade of relative quiet is, well, it's almost unheard of. And it's this unusually long stretch that sets the stage for everything we're about to talk about. For a full 10 years, the Indian market has managed to avoid a true, painful, prolonged bear market. And get this, even that massive, scary COVID crash back in 2020 doesn't technically count. Why not? Because the market bounced back and recovered all its losses in just 9 months. It has been an incredibly smooth ride for investors, almost unnaturally smooth. But that leads us to the big question, doesn't it? History tells us that these periods of super low volatility, they just don't last forever. So is this quiet, calm party about to come to an end? Look, nobody complains when the market is calm, right? It feels great. But the data suggests that after a run this long, a lot of people in the market just aren't prepared for things to get bumpy again. So let's look at the first signal that things might be starting to shift. For years, India has been one of the star players on the global stage, right? Attracting tons of investment, delivering really strong returns. But lately, that whole picture is starting to look a little different. Okay, take a look at these numbers. According to projections for 2025, India, after leading the pack for so long, is expected to be one of the worst performers among 24 emerging markets. Just a 4% return. Now, compare that to places like Colombia and Korea. We're talking triple-digit growth. That's a huge change. And this chart just puts that into perspective. Look at that tiny little bar for India next to those massive towers for other markets. It really shows you a massive reversal of a trend that's been in place for a very, very long time. All right, signal number 2, and this one is a big one, happening right here at home. The small and mid-cap stocks, which have been a huge favorite for retail investors, are starting to feel a serious, serious pinch. So the excitement around these smaller companies just pushed their prices into another stratosphere. Their median price-to-earnings ratio, which is basically the price you pay for $1 of a company's profit, hit a peak of 46. To give you some context, the long-term average is just 20. Things got way, way ahead of themselves, setting the stage for a pretty painful correction. And believe me, this correction is widespread. This isn't just a few bad apples. Over 80% of small-cap companies are down more than 5% from their recent highs. And look at the chart. Most of them are suffering these really painful double-digit declines. The pain here is real, and it's broad. Okay, our third signal takes us from the domestic market and puts us back on the global stage. Indian exporters are still dealing with a major headwind, and that is these persistent U.S. tariffs. This timeline really shows the roller coaster they've been on. For manufactured goods, we went from a pretty manageable 3% tariff before 2018 to a crippling peak of 35% during the trade war. Now, things have settled down to 15%. So yes, it's an improvement, but that's still 5 times higher than it used to be. The report's conclusion on this is just perfectly blunt. This is tariff relief, not normalization. It's not a return to business as usual, and that's a constant drag on how competitive Indian exports can be. So, with all of these challenges popping up, what's an investor supposed to do? Well, this brings us to a really strange situation in the market right now, where what's popular seems to be completely at odds with what's actually a high-quality business. Before we go any further, let's just quickly nail down a key term: return on equity, or ROE. The easiest way to think of it is like a report card for a company. It's a grade on how well it uses investor money to make profits. A higher ROE, a higher grade, just means it's a better, higher quality business. Simple as that. And here is the paradox. The market rally lately hasn't been driven by those A-student, high ROE companies. Instead, it's been propped up by weaker, more cyclical businesses. It's kind of like building a house on a shaky foundation. It might look good for a while, but it's just not stable. So where is that quality hiding? Well, take a look at the report cards for sectors like fast-moving consumer goods and IT. Their ROEs are consistently fantastic, way above the market average. These are the traditional, reliable engines of the Indian market, and right now, they're being completely ignored. This chart really drives the point home. The combined weight of these high-quality sectors in the market is at a 15-year low. In its chase for riskier bets, the market has just turned its back on them. Now, for a patient investor, that might be where the real opportunity is hiding, right in plain sight. So the big question is, how do you navigate this really tricky environment? The answer isn't about panicking. It's about being prudent, being smart, and taking a hard look at what the data tells us about the price of, well, everything. Let's just do a quick scan. Look at these historical rankings. A 99th percentile basically means prices have almost never been higher. Gold and silver, at the absolute top of their historical range. Global stocks and Indian small caps, not far behind. It seems like the party's been going on for a long, long time. This really lays out the choice for investors today. On one side, you have all the crowded trades, stocks, precious metals, that are now historically expensive. And on the other side, you've got government bonds, which have been pretty much ignored. And because they've been ignored, they're starting to look relatively attractive. So why even look at bonds? Well, first off, inflation in India is at a 50-year low. That's a massive tailwind for fixed income. Second, government borrowing is under control, so you're not getting a flood of new supply. And maybe most importantly, they offer higher yields than short-term rates, and they give you a crucial margin of safety when almost every other asset out there looks pretty risky. And all of this leaves us with one final thought. We've just lived through a decade where chasing momentum, just buying what's hot, has paid off handsomely. But if these signals are right, if the market really is shifting, the entire game might be about to change. It could start rewarding patience and prudence over pure speculation. So the real question is, are you prepared to think differently?